David Swank, one stock you like in the Hood River Small Cap Growth Fund is VCA. This is ticker WOOF, W-O-O-F. It's an animal healthcare company. So are people going to be spending more on their pets because of lower gas prices? Is that the thesis?
Well, Greg, the company is actually off to a great start fundamentally this year. They've seen revenue grow at about 8% organically as the consumer has come back to the vet. In addition to that, they're starting to see good traction from their pet wellness program, which is leading to more consistent revenue growth. So over the next couple of years, as the consumer continues to utilize their veterinary hospitals, they should see some nice operating leverage, which will lead to margin growth. I think that they should earn about, call it $370 in 2017, and if they trade at 20 times that, that would suggest that they should be trading north of $70, and right now the stock's at 50, so there's pretty good upside there.
All right, let's move on to another form of healthcare, human healthcare. You like AMN Healthcare Services. This is a staffing company. Stock got down to around 22, but it's bounced back to about 29. They beat earnings last week. What takes it higher from here?
Right. Well, AMN is seeing really robust demand from hospitals for their healthcare staffing. And that's being driven by a couple of things. First of all, hospitals have seen good patient volume growth over the past couple of years, and combined with an aging workforce where, for instance, a lot of nurses are starting to think about retirement or going part-time, it's really driven demand off the charts for these guys. So they're not so much constrained by demand as they are by their ability to actually recruit nurses and doctors to work in the hospitals. So over the next couple of years, they should be able to grow, my guess is at a 15 to 20% rate top line, and the street's looking for 210 in EPS in 2017. I think it would be more like 230. If they trade at 16 times that, that would get to about a $37 price target from 28 today.
Staying in the staffing arena, you also like On Assignment. This stock's down almost 30% this year. What's going on with On Assignment?
Sure. Well, historically, On Assignment has grown faster than its industry. It's a well-managed company. This year, the stock has gotten hit because of fears of a recession in the US, which is not clear will actually happen by any means. Right now, the company has not seen any change in its business environment. And in fact, I think that they're set up to grow their top line at a mid-teens rate this year, because last year they implemented a hiring surge for recruiters. And as those recruiters get up to speed on productivity, it should help sustain a high rate of growth for them. So right now the street's looking for a little over $3 a share in EPS growth in EPS in 2017. I think it's more likely to be, call it 350 or 375, which I think should get the stock up to about a $50 target price versus the low 30s today.
All right, and then finally, you like ComScore. Now, this stock was over $60 last summer. Now it's about 42. So how do you get it back up to 60? I mean, I know they're tracking everything on the internet. They're probably tracking us right now. How do you get that stock back up?
Sure. Well, in January, ComScore completed a really exciting acquisition of a company called RentTrack that measures TV audiences. And they compete with Nielsen, but RentTrack has a vastly larger sample size and has much better granular data than Nielsen. So the exciting thing here is that in the second quarter, ComScore is going to roll out a new product called Total Home that will measure audiences across TV, mobile, and internet, which is really the first product of its kind. And the folks that I've spoken with in the advertising industry are really excited about it, and I think it's going to meet with a good reception. So ComScore should be able to grow revenues better than 20% organically over the next 2 years and quite possibly beyond. The street's looking for about $155 million in EBITDA in 2017. If their new product does what I think it can do, I think that they'll be able to do better than $175 million in EBITDA, and at a 15 times EV to EBITDA multiple, it should be pretty much back to the $65 level I saw earlier.
All right, well, thanks a lot, David.
Thank you, Greg.
And thank you for watching The Street.